Hey, good morning, good afternoon, wherever you are. My name is Jeanmonod, EVP of production here at Angel Oak Mortgage Solutions. It's been a while since I've been on one of these, so I'm really excited. I'm going to introduce our subject matter experts here in about 30 seconds. So hopefully everyone's having a great day. I'm playing a little bit of an away game, so if we have some technical difficulties, Ben and Chris will have to carry me across the finish line. So
no problem.
We're going to talk today. We're going to talk about our debt service coverage ratio program. It's the most popular program unit-wise, and I'll let Chris. I don't want to steal Chris's thunder because he's got a great name for it. So, and then we're going to talk about short-term rentals. If we have a little bit of time, maybe cover a little bit of foreign national. But we're going to show you some great tools to use, our quick quote, our marketing portal, a lot of great things at your disposal. I'm here today at the Florida Association of Mortgage Professionals. We did a breakout session. There was a lot of questions asked and a lot of things that still, as long as this program has been out there, people don't know, which is great. That's why we're here. So, all right, it's a couple minutes after the top of the hour. Let's get started. But before we get started, a couple house rules. This is going to be recorded. We will get this out to you before end of day tomorrow. And if we don't get to all your questions, we will have your account executive reach out to you and answer any questions that we may have missed. So, but before we do that, let's launch a poll and ask our audience who has originated a debt service coverage ratio in the last 12 months. So while you guys are responding to that, again, hope everyone's having a great day and a great month, even better. So I know, Chris, you're having a great month, so congrats.
Thank you.
All right, couple seconds here. We'll launch the poll and get the results. Wow. Gentlemen, ladies and gentlemen, 67% of you have not originated a DSCR loan in the last 12 months. This is great. This is why we're here, guys. This is a great opportunity for one of literally the easiest loans in the history of the mortgage business to close. So everything we're going to do today is on our website. And, you know, again, there's no PowerPoint, and we're going to launch right into our debt service coverage ratio program. Chris, start us off, buddy.
All right. Chris Barker, been with Angel Oak for 9 years. I think the reason that's important is you'll find at Angel Oak, a lot of our AEs are experienced, know the guidelines inside and out, forwards and backwards, and they will be your literal tour guide through the world of DSCR. So the 67% that haven't done it, be confident that you have an AE there to literally hold your hand from the pre-qual stage to document submission all the way to closing. So if you don't feel real confident about doing this first one, know that you've got an AE there that's done literally thousands of them that can answer all your questions. What was that question again, John? Sorry, I got hung up on my intro.
No, you're good, Chris, and I apologize for not introducing you.
Oh, no worries.
Now let me introduce Ben. And this is live, so everyone knows this is live. So,
no problem at all. Hi, everyone. My name is Ben Scribner. I'm the regional sales manager for the Northeast. I've been with Angel Oak for 6 years and change. To add on exactly what Chris said, the expertise and the experience makes all of the difference. And obviously we'll go through all of our, through the crux of the program, but just knowing that, you will have that dedicated point of contact that's going to be with you every step is huge, exactly as Chris said. So excited to, talk about this program with everyone, and we'll let Chris take it off.
Yeah, Chris, so just go over the highlights. We're going to have Ben cover, what we want on the 1003, what we don't, and credit, and then we're going to open up the Q&A. Chris is also going to talk about short-term rentals and how we look at those. And so go, Chris.
All right. I think the super value of you guys being on this phone call today is this, the debt service coverage ratio allows you guys something new to talk about to realtors, borrowers, buyers, investors. You can even do investor seminars. and you can call in the AE to come in and do it for you. Like I said, we're experts at it, and you'll be an expert at it after doing 2 or 3 of these. But the value is, and there's so many. Gosh, I could start with rate. The rates are awesome. A lot of people right off the bat go, "Is this a high rate thing?" In the last month or two, we've even seen rates lower than conventional. And the reason for that is with conventional Fannie and Freddie, you've got those nasty little LLPAs that are on these loans. So if you see a low LTV investment property and you compare it to an Angel Oak DSCR, you're likely to see that the Angel Oak DSCR, which again, keep in mind, is a no income, no employment, no DTI, very easy to close loan, is actually a better rate than the conventional full income documentation, tax returns, 4506, all those painful things. So the value is in your sales pitch and your ability to serve the customer, in the loan officer's ability to have something that the other guy who's not on this webinar, think about this, at the end of this webinar, you will literally level up over the loan officers that aren't on this webinar, because you will have learned about a product that they just don't offer and can't have. So who is this loan good for? So when would you use us? Well, number one, I would look at us every time because it's a good, easy loan. Number two, and this is really nuts and bolts, let's say you got a borrower who just went W-2 to 1099 or 1099 to W-2 or W-2 to undocumentable employment. On the 1003, you can literally, let Ben cover that, so I'm going to move on. There's no DTI. So this is the target customer that you're going to look at. So let's talk about, people call this the sexiest loan out there. I think that's a terrible name. The reason they call it sexy is because it's a no-doc, okay? I think the most accurate name for this product should be the most bulletproof loan in the real estate industry. And here's why. Let me prove it to you. So let's go back just a little bit. Debt service coverage ratio, DSCR. That's still a mouthful of words. What does it really mean? It means, almost do the letters backward, DSCR. Does the rent service or cover the debt? Okay. So what is the debt? The debt, another mouthful of words, PITIA. Let's just call that the mortgage payment. We all know what that is. Okay. So I'm going to give you 3 examples of the bulletproofness of this loan. In each example, the target to hit is $1,000 PITIA. So let's just call that the mortgage payment. Okay. So here's example 1, and you can write this down and we can email this to you. Example 1 is your basic vanilla DSCR, which means your rent needs to cover or service the debt of $1,000. Okay. So if the mortgage payment is $1,000, what does the rent need to be? $1,000. Okay. So here's how it works. So let's say John orders the appraisal. On that appraisal, this is how we determine what that rental income number is. John orders the appraisal. He orders a 1007 market rent analysis. The appraiser goes out there and he says, hey, in my professional opinion, looking at 3-bedroom, 2.5 bath, 2,500 square foot comps, this should rent for, what was their target? $1,000. This should rent for $1,000 a month. Bam, off to closing you go. No VOE, no pay stubs, no 4506, no tax returns, no W-2, no updated pay stubs, nothing. How easy is that loan to close? That's your basic vanilla DSCR, 1-to-1. Okay, now let's prove the bulletproofness of it. So this time, same thing, target to hit in all 3 examples is $1,000 mortgage payment to cover. Ben orders the appraisal this time. He gets the 1007 back. 1007 says, in my professional opinion, this property should rent for, again, the target hits 1,000, should rent for $800. Uh-oh, we're a little upside down, we're a little underwater. Will Angel Oak still close that loan? The answer is yes, as long as you have a 700 credit score and the LTV is no greater than 75%. Now think about that. Most of these are 80% anyway. We do go to 85%, just so you know. But so they put 5% more down. They have a 700 score. It's a 0.80 to 1 in that tier. Boom, off to closing you go again, right? Now, I'm really going to show you the bulletproofness of it. This time, Chris orders the appraisal. Appraiser goes out there. He does the worst job in the history of appraising. And he comes back and he says, in my professional opinion, again, the target hits 1,000. In my professional opinion, this property should rent for zero, nothing. Will Angel Oak still close that loan? Yes. If you have a 720 credit score and the LTV is no greater than 70%. Now, let's get real a second. Does that ever really happen? No. Here's what happens. Your target hits 1,000, the appraiser says 950. You want to get back to 1-to-1, or the target hits 1,000 and he says 750. You're a hair under that 0.80 to 1 that only requires a 700 score and a 75 LTV, but it's just you're a hair off. What does a smart loan originator do? You got to bring it back to 1-to-1 or 0.80 to 1. You want to bring it up. Here's what you do. You renegotiate homeowners insurance $50. You can buy the rate down a little bit. You can put a little bit more down. Nobody wants to do that because that costs money, okay? You can do an appraisal rebuttal, find new comps. I've seen them do it every time. They'll go back and go, hey, based on new information, it's $50 more a month in rent. But here's the easiest one, and it is the separator between QM and non-QM. The easiest one is just go interest only. So instead of your target being PITIA, it's just ITIA. So instead of your target being 1,000, your target's 950, your rent's 950, boom, off to closing you go. So this is what I'm talking about by having a team behind you that really understands these loans. And as we're a tour guide through this for you, the AEs and the managers are going to go, hey, we can fix this real easily. Just drop the homeowner's insurance here. Go interest only. Buy the rate down to 8. Whatever it might take and whatever that borrower wants to do, we'll do it, and that loan will close, and you will go back and get some more and more and more, and they will tell their realtor buddies how great you are. And that's really our goal today, is that to boost your business, that you guys really level up and get a value out of this phone call that you can take out into the field and get more and more and more. That's pretty much.
Hey guys, are you able to see the website?
No.
Oh, should have been. Sorry about that.
Yeah, and John, while you get that up, Chris, to add on what you're saying, the big part about this program really is who it fits. It really does fit everyone. First-time investors are not an issue. LLC vesting. Say someone's gone over their Fannie Freddie cap on financed properties. You have all of these caveats, which may even put a traditional full doc borrower into this kind of category. And to Chris's point, the rates are absolutely incredible. So there's so many different caveats to this program that really cast a wide net to make sure that, all of you on this call, that you have an option. If you ever have an investment property, don't ever turn it down until an Angel Oak AE sees it. Don't do that. Let us get a look at it first, of course. We see the screen.
Everyone, you, Chris, Ben, everyone on the call that, I didn't know my screen wasn't sharing. So, but Chris, hit some of the highlights, like LLC, right?
You can close in an LLC, an LLP, an S Corp, a C Corp, or a revocable trust. We've got you covered on that. You need a 680 score to get into the program. The minimum loan amount is $100,000. Now, if it's a condotel, it's $150,000. So just keep that in mind. Again, your AE will watch out for you. And on this website where John is, there's a quick quote tool that I think is the best piece of mortgage tech out there, because it has our matrix incorporated. You'll see a lot of non-QM lenders will have a rate quoting tool on their website. It's just that. It does not have the guidelines built in where you go, hey, I got a 680, I'm trying to do a $95,000 loan at 85 LTV. It'll kick you back and go, hey, here's the best I can do. With that score, I'll do 75 LTV, and you need a $100,000 loan amount to approve. So, and all this stuff can be answered in like 10 seconds. It's that easy. The maximum loan amount, you'll see this too, is $3 million. You can put interest only on this, which is fantastic. A little bit about interest only. And a lot of our customers are realtors. Imagine how beneficial interest only is to a realtor borrower who may or may not make a real estate sales for 3 or 4 months. Why do people buy investment properties? One reason, cash flow, and 2 reasons, cash flow and appreciation. But how do you maximize cash flow? You either increase the rent on the renter, ouch, that's hard, or decrease the payment on our borrower. Best way to do that? Interest only. The great thing about that is, let's take that realtor example. They go 0 for 2 or 3 months. They go out and kill the whale, make a big commission, want to put some down towards principal. Every time they do that, we recalculate, recast, and reduce the next payment. It's beautiful. And guess what? QM, qualified mortgage, by definition, cannot do that. So another awesome thing that Angel Oak can do. 6% seller concessions.
Yeah, thank you. Took the words right out of my mouth. I was going to ask you next.
Actually, 6% seller concessions on all of our programs. So I get that question a lot, and people go, "Oh, thank you, that saved the deal." You know, you just never know when something awesome like that pops up. But this is you've got to know this product. You in order to be a complete loan originator with a full toolbox that can really take care of the realtor and the borrower, you got to know this product, because if you don't, the guy across the street he's going to have it. I promise you. We're closing thousands of these. I mean, it's out there.
Yeah. So one of the questions Leon's asking, are these all 30-year fixed? Chris, I'll let you answer that one.
Yes, unless you do interest only, then it's a 10-year interest only period, and then it becomes a 20-year regularly amortizing loan. But yeah, everything we do is 30-year fixed. I get asked a lot, "Hey, can you do an ARM?" The answer is you don't want to do an ARM. The rate is probably higher. There's no benefit, but yeah, everything's 30-year fixed.
And Ben, I'm going to let you answer this question, and then we'll talk about the 1003 credit. I know we've been saying we're going to get there. Sure. Are appraisers able to accurately value short-term rental income?
So that's a little bit of my background. I actually spent almost a decade in the AMC space. So there is a lot of conversation around short-term rentals and a market rent analysis, whether, certified appraisers are supposed to be doing them on that form, whether they're supposed to be general, like commercial-ish. The answer is it's kind of a mixed bag right now. So we do have multiple AMCs on our list that do have a specific short-term ordering form. So the scope of work for the appraiser actually does state that we are looking for short-term rental. There are several AMCs that are actually moving away from that. Obviously, we don't control that part. Wish we could, but as the appraisal world goes, sort of in one direction, we do have those options. We do have AirDNA options available. And for a refi, a lot of people don't know, but if you have a refi and you have been renting that, we can actually take that Airbnb or, what's the other one? Whatever the other, the RBO, that's it. We can actually take those rent rolls and we can base that market rent analysis on that, with obviously confirmation that, that those rents are received. We certainly can. We have, multiple AMCs that do specify short-term rental for a 1007. There are a lot of AMCs that are going against that grain. But John, I wanted to add one point before we move on to the 1003 and everything. A lot of times, and guys, we all know investors and this part of delayed financing is a huge part of this. We all know that cash is king, right? Everyone is going out there and striping up, because cash offers obviously just have that sellers love that, no contingencies and a cash offer. But real estate investors don't want to really tie up their cash that way. Of course not. So delayed financing allows you to take out, that 80%, 75%, whatever it is, back out at purchase LTVs and rates. So you're not getting dinged for that cash out. It's not a big ding, but you don't have that cash out LTV. You have that purchase LTV for delayed financing within 6 months. Yeah. So I just wanted to throw that out there, Tom.
Yeah, no. Great question. Steve was asking, can we do Steve's asking two questions. His first question was, can we do this on purchase, refi, cash out? And now you talked about delayed finance. And Steve also asking another great question. Where did I lose that, Steve? Oh, can he get a pre-approval prior to finding a property? Chris, I'll let you answer that one.
I think that's a beautiful aspect is with you can have a TBD property on your 1003, and before, this is really doing your realtor a favor here. Before that realtor throws a borrower in the car on a Saturday and shows them 5 properties and their credit doesn't work out, or something doesn't sit in the structure of our guidelines right, your AE will pre-qualify, really pre-underwrite that file and issue a beautiful little pre-qualification determination, similar to DU or LP findings for those of you that haven't done these before. But you can hand that out to your realtor and go, hey, go shopping. They're qualified up to this amount based on their credit history and things like that. It will really benefit you so that you don't have to disclose. You don't have to wait and go into initial underwrite. That I literally did one today in 5 minutes.
Yeah, Chris, you hit on that, and we did a breakout session earlier today at this trade show we're at, and we emphasized that doing the pre-qual up front, getting all the guesswork out of it done by your account executive. And if your account executive is not 1,000% sure, we've got a help desk, and that if we get an exception, 30% of the loans we close don't meet our guidelines. So if Chris and Ben or anyone on his team, gets that exception follows that through all the way to underwriting. So Ben, let's talk about what we want to see on a 1003, what we want to, or really more of what we don't want to see on a 1003, and then let's talk about what you look for on the credit report.
Absolutely. The best part about this loan is really just how easy it is. We, as Chris mentioned, we do not want to see employment. We do not want to see income. We don't don't import the liability. The biggest thing on our 1003 is the REO. So because this is a no ratio loan, we really are looking for that credit history for mortgages, right? We do, first time investors are absolutely not an issue. We don't do first time home buyers on this program. So, we do want a borrower to own a primary, but if they don't have to own a primary, if they have that landlord experience, say they own 3 or 4 or 5 investment properties, then then we're not concerned at that point because they're going to have that track record. But that's really the benefit is how simple. Like as Chris mentioned, he can pre-qual this in 5 minutes because what is he looking for? He's just going to take a glance at the 1003, check the REO, make sure if he does rent, that he does own other REO. If he owns, great. Occupancy fraud is definitely the only concern on this program. So we need to make sure that this isn't going to be occupied by the borrower, right? It's gotta make sense. We're really looking at credit. Our trade line requirements are pretty simple. We're looking for 3 trade lines for 12 months or 2 for 24. We do allow some late in collections out there. We obviously don't want to see someone in trouble recently. But if you have a 30 here, 30 there, that's, even if it does fall out of our guidelines, we do want you to send that to us because, as John alluded to, we will send that to our credit team and we'll get that pre-approved up front so that doesn't, come to bite anyone in the backside down the road, right? So, we don't want you to really look at credit too tightly. And in fact, right now, less credit or less debt actually makes a stronger borrower at this point. It's funny, like a lot of times, before 2020, it was, wow, they don't have enough credit now. Well, now it's, wow, they have no debt. That's actually a better looking borrower. But that's really the crux of it is just that credit profile, just making sure that, hey, that this borrower is solid. And, that 1003 is really, just that REO is really what we're looking for. I'm not sure if I'm kind of missing it. I went through that kind of quick.
Yeah, no, it's good though, but it's pretty, like you said, it's minimal, so got a couple of good questions coming in here. Chris from Janet is asking how much gift funds can be used.
Gift funds are allowed as long as the borrower has 10% of their own funds for the down payment plus 6 months reserves from their own funds, but the rest of it can be gifted. And I'm gonna go a little bit further on this one. And you turn the recording off for this. So
Okay.
we only see the funds 30 days. Okay. So think about that. If we don't see the deposit come in, we don't care where it came from. And I joke around all the time. I shouldn't even say this. This is a joke. Okay. This is a straight joke. This is facetious. If they go out and rob a bank and they put that money in their account and we don't see the deposit, 30 days is all we're looking for. We don't care where it came from. That is a joke, but it's an illustration, okay? But that's, but for example, let's say it's gift funds and they get it 60 days ago. We don't see the deposit. It's not even we're not even going to go, hey, we need you to document that. We're not even going to know that it's a thing. It's not part of our guidelines to question that. So again, just know we try to make it really easy on you to close these loans. Gift funds are allowed. I'll leave it. You can turn the recording back on now.
So, good question.
That was good.
Again, Ed's asking, Ben, I'll ask this to you. So he entered a few minutes late. We won't penalize you, Ed, for that. How many units is this eligible up to?
Yeah, we don't go above 4 doors right now. We're hoping to get our 5 to 8 here before the end of the year. So be on the lookout for that. Obviously, our great marketing team will the whole world will know when we get our 5 to 8. That'll be coming hopefully soon. As far as exposure, if that was kind of, I don't know if it was how many units per unit.
That wasn't the question, but I think you can add to that, though. I think it's helpful.
Yeah, I mean, our guideline is 5 units to 3 million for maximum exposure. We go above that all day. Yep. So that's what we kind of mean when we're looking at guidelines. Just like credit, just like late, there's or even reserves. We're not if we have a good loan, we're not going to turn a loan down because they only have 5 months reserves, and our reserves are only on our subject property. So there's some people out there that do want 3 months on every piece of REO they own. We don't look at it that way. We want 6 months on ours. But are we going to turn away a good loan because they have 5 months instead of 6? Of course not. So, that common sense underwriting is actually, a hallmark of Angel Oak. So, I mean, I know Chris has done 10 packs. I've done 10 packs before. Yeah. So the 5 unit or 3 million, it really just depends on the borrower's credit depth. Are they solid? Do they have, a ton of REO? It makes a lot of sense, especially in the cash out world right now. This program is getting extremely popular with cash out. Especially as, we're hitting your 4th quarter, right? Everyone's looking at end of year. Everyone's looking at tax bills. Cash out's becoming a big, big part of the picture here after purchase season's over. So, for everyone on this call, be sure that, you're actually looking at this, from a cash out perspective also. It's not just a purchase program. In fact, I'd say it's about 50-50, I'd say right now.
So, Chris, Scott's asking, what percentage of the rents are used? What percentage of the rents are used in the DSCR calculation?
So I think he's asking, when you get the 1007 back, what percentage is used? So the reason he's asking that is, let me answer that real quickly, all of it. Okay, the reason he's asking that is some of our competitors give that 1007 rental income figure a haircut, as they call it. So, for example, and let's go back to the easy example. The target to hit was 1,000. The 1007 comes in, it says 1,000. Another lender might give that a 20% haircut, and boom, you're at 800. And we see that a lot when you get into short-term rentals, where it blows my mind that anybody would use any other lender that would take that number and give it a haircut when you have Angel Oak sitting there that uses all of it.
Yeah, great point. Ben, does this work? Angela is asking, does this work for mixed units? And I would basically say mixed units.
Yeah, unfortunately, right now we don't have a mixed use program. Hopefully that will be coming down the pike as well. Mixed use is obviously huge in Chris's market in South Carolina and through the through the Carolinas in general. I'm in the Northeast. Don't hold that against me, but mixed use is a huge part. So we definitely anticipate that going live hopefully as soon as possible. It's so popular over the coast that it just makes a lot of sense. These are great performing loans. Mixed use is a great performing loan. So, hopefully soon. I hate to kind of put that on the back burner for everyone on this call, but, I think it'll be a huge program as soon as we can get that live.
So, Chris, I know you mentioned it. It is, Kyle's asking, is it for first-time investors permitted?
Yes. Yes. As long as it makes sense. So let me follow up on the bulletproofness of this loan. It is not bomb-proof. Okay. And here's the bomb that will kill this loan. Let's say you have a first-time investor, to address that question, and they're living in a $200,000 primary outcome. And in comes the DSCR request for an $800,000 investment property on the other side of town. What's really going on there? Hold on, I got an underwriter calling me.
Hold on. What do you think?
I've got an underwriter calling me. Sorry. So they're trying to buy an $800,000 property on the other side of town. What's really going on there? What's the concern that an underwriter, speaking of, is going to come up with? They're going to go, this is a potential occupancy concern where the borrower who's living in a $200,000 primary could be circumventing DTI in order to upgrade their primary to an $800,000 new primary. So those are the things you got to watch out for. What we're really looking for is somebody, here's a more vanilla example. Somebody who's living in a $400,000 or $500,000 primary and they're buying a $300,000 investment property where it wouldn't really make sense for them to downgrade where they're currently living. Of course, we love the $3 million DSCRs. We do them. But keep in mind, we kind of want to know that you played in that ballpark before. There's another example. Let's say you live in a $500,000 primary, buying a $3 million investment property using no income, no employment. We're going to look at that one a little bit harder, and it's got to make sense. But yes, you can be a first-time investor as long as it is making sense to the underwriter.
Yeah, great questions coming in. I know we're halfway through. I don't know if I asked this question, guys, and I'm getting old, so bear with me. Does this have a prepayment penalty?
You want to cover that, Ben, or me?
Yeah.
Sure. Absolutely. They do have this our investment properties do have a prepayment penalty. We have a standard 3-year. You can buy that down from 3 to 2, 2 to 1, or out. We also have a 4-year with a rate reduction. So you always do have that out there. I always encourage every loan officer to leave at least a 1-year prepay. It does keep that EPO from kind of rearing its ugly head. As we see rates moving downward, we don't want to go down that road as much. But absolutely, we do follow state rules. So here in Pennsylvania, where I live, anything under 312,000, 312,500, whatever that dollar amount is. We do follow each state specifically. But they do have prepayment penalties on them. But the best part about this is, this program is really a debt management kind of, especially for your routine investors. So they are just looking for that cash flow. They're not really looking to flip out of these loans very often. Obviously, there's the cost associated with it, but these loans don't pay off early because their rates are great. They're cash flowing. And they're just looking at that appreciation on the value of the property. That's what they're looking long term. So, we don't really see this, we don't really see it as an issue. But to answer the question, yes, we do have a prepayment penalty on it. It's just 6 months interest of 20% of the remaining principal balance. That whole verbiage.
Yeah.
We can always. Chris? Yeah.
I don't think anyone ever says it the same way.
Somebody asked me, I'm like, hey, I can quote it to you, but you're not going to get it. It's 80% of 6 months interest portion of the payment. And they're like, holy, what did you say? So, and that's, each state law can be different too. Sometimes it's a 2% max, like if you're in North Carolina, and I think Ohio's got, a certain loan amount, but it's each state is a little bit different. But yeah, we can do a 5, a 4, a 3, a 2, a 1, or a none. We can actually do no prepay penalty on this. Now, keep in mind, and this kind of blows people's minds when they're going through quick quote, and you might want to run that one through the screen if you can, John, is they'll be like, hey, they don't want to prepay. And my first question is, why don't they want to prepay? Because I don't want an EPO and you don't want an EPO either, right? And they're like, yeah, let me ask them about that. But here's what you'll find. So as Ben said, the 3-year prepay is kind of standard. It's middle of the pack. The lighter time frame you commit to be in that loan with us, the higher the rate's going to go. The longer, let's say you took a 4 or 5 prepay, the rate gets better. But here's where it gets kind of confusing. You can buy the prepay out, and you would assume that the rate would go higher. Nope, the rate's actually lower. The reason for that is we don't want you to be able to get out because it takes us, about 12 months just to break even on these loans through the interest payment. So we want you to stay in there. So you have a really low rate that would be very hard to find a better deal on, but there is a cost associated with it. Cost goes, exorbitantly high compared to a 1 or a 2 or a 3 year prepay. So just watch that. And, we don't want anybody neither one of us, either side of the 1003, the LO or the AE, we don't want people, or the lender, we don't want people prepaying. So that's the way it's done. Now, also keep in mind, because some people ask me this, hey, is there a prepay penalty on this bank statement loan? And it's like a primary OC. Just know that we cannot put prepayment penalties on anything unless it is an investment property. So just don't confuse that when you get into our other products. They're only allowed on investment properties, and they can't be bought out.
Yeah. So Ben, speaking of prepayment penalties, cash out reserves. Can cash out be used for reserves? John's asking that question.
Absolutely. The beauty of cash out is how this loan is easy just from the outset. Cash out is even easier because you don't even need assets. Cash out counts toward reserves. Again, Chris mentioned our minimum loan amount, so if you're going to have at least 6 months reserves out of that. So on a cash out, you're literally a driver's license, a credit report, and an appraisal. That's really all we're looking for at that point. Other than maybe a couple of LOXs, if there's something that, we need an explanation on. Cash out counting toward reserves. And again, we only need 6 months on our subject property. So, you don't even need assets on this program on a cash out, which is, it just makes it even easier because there's no sourcing, there's no seasoning, we're not looking for large deposits or gifts from family or anything like that. How easy that is. It just takes an easy loan and makes it even easier for a cash out.
Yeah. Hey, Chris, and I brought this up because I'll probably go answer this for it, but are we able to lend in states that we are not licensed in? Pam's asking that question.
Great question, and you're going to love this. The answer is yes. So as long as you have an NMLS license and your company has an NMLS license, we allow unlicensed activity in, I believe it's 12 states. You got Colorado, Florida, Georgia, Tennessee, Louisiana, New Mexico, Ohio, Pennsylvania, South Carolina, Washington, and Wisconsin. And I think we're probably looking to add a couple more to that. But
hopefully,
there's not a more fun phone call than a LO calling me up going, hey, I got a DSCR loan in Georgia or something like that. And go like, well, and they ask me to refer it to someone there. And I go, you can do that one yourself. And they're like, boom, paycheck, that's awesome. So if you want to originate in one of those states, just email your AE. They'll have that list together with a very short document to fill out that says, yes, my company authorizes me to do unlicensed activity on DSCR, because it's really kind of a business purpose loan. We have it, and you can use it through us.
So Vicky is asking, and I'll answer this one from a standpoint. Yeah, Vicky, this is not a PowerPoint. Everything we're doing here is from our website, and we're going to go to a couple more questions, and then we're going to get to Ben doing showing us how to get a quick quote and how to and how to get us a quick quote, or pre-quote. But Vicky, this is being recorded, so this isn't a PowerPoint presentation. This is being recorded. We will send this out, the audio, the visual, all that will be sent out to you before end of day tomorrow. So let's ask Karen, we do foreign nationals on this, only up to 70%, and it's still done under the DSCR, and it has to be a 1-to-1 ratio. So we'll answer that. And we'll have your account executive reach out to you to do more detail on yours if you have a specific scenario. If one of the buyers is a first-time buyer and the other is not, will that work? Yeah, no, Ed, I know we answered it in the queue, so that won't work. Both would have to have been previous real estate owners. We're gonna get to, Regina. We're gonna go to. We're gonna show you what rates will look like here in a minute, and so let's go there, Ben, because we're gonna run short of time, and I want Chris to get into probably the most slickest marketing portal in the history. So.
Absolutely. And guys, exactly, Virginia, like Our website is absolutely interactive, so all of our programs, all of our basic guidelines are there. So please, angeloakms.com. As soon as you see the bridge, you're in the right place. Our non-QM quick quote tool is incredibly easy, incredibly fast. It's even mobile friendly. So you can do this from your phone. You just come to our website, angeloakms.com, hit the non-QM quick quote, and you just want to fill out just the broad strokes of your scenario. So yeah, John's going to just punch in, again, we do bank statement HELOCs. We do a lot of, we do second lien products and all of that. John's just going to.
And we just did a presentation on our average credit score for this borrower is a 760. So.
Yeah, these are good borrowers. Absolutely. The reason why these rates are so great on DSCR loans is because how well these loans perform. Also, I mean, from the secondary perspective, this loan outpaces just about every other loan program, Fannie, Freddie, FHA, VA. I mean, it really is a great performing loan. So yeah, John's just punching in. We're gonna do a purchase. We're just gonna, just for the sake of it, just a single unit. We do go up to four units on it.
Hold on, I missed one field. Sorry.
Yeah, there you go. Just say, hey, cash flows. Just gonna leave it standard 3-year prepay. Again, max LTV. This will show you what your max LTV is, and say, you had a lower FICO, it'll show you if say you had a 680 or so, it'll actually show you what your max LTV would be versus what you requested. So, John here punching a 75, it'll show you what your max is, and it'll give you that ballpark rate. You can always and again, bankruptcy seasoning on this is 4 years. That's one, because again, there's a no ratio loan, so we do want a pretty clean borrower on that. So, foreclosures are a big one, but, bankruptcies, deed in lieu, things like that, forbearance, that's always something we want to take a look at. But, right there, and again, everything's put on a 30-year. If you want to go ahead and hit view rates, John, you can actually pull up a rate stack. Again, that's done today. You can price in your lender paid comp if you'd like as well. This isn't a lock. This is just for your information, just to kind of show you, where that rate stack looks. And to Chris's point, these rates are pretty incredible considering how fast, how easy, and the limited documentation that we're requiring. It really is, pretty incredible rates. And again, you can price in your lender paid comp here. And again, this isn't a lock, so it's giving you that idea. But to send us a quick quote or a quick qual, which Chris alluded to as well, we pre-qual every single scenario before it hits our underwriting door. We are not in the business of dragging scenarios out, loans out, having them die in the 11th hour. We want to get any exceptions up front. We're going to get bank statement income done up front. We're going to get any questions that are needed. We get those answered up front, and we do that through our quick qual system. So you just go to our quick quote, punch in your scenario, select a rate. Again, that's just a qualifying rate, and hit next.
Sorry.
That's okay, John.
Sorry.
Everyone can see it again. You'll hit that view rate, and then you'll hit next. It'll take it. You can skip the 3.4 upload if you want to. You can absolutely do that. For a DSCR loan, the 3.4 doesn't really do much because we're not calculating any. There's no income, there's no liabilities or PTI, so 3.4 doesn't really make a lot of sense.
I'm catching up.
Coming here. Okay. This is also a secure site. When you're talking about NPI and things like that, all the documentation is going to come through securely. John's going to get that. So you hit select option. Again, if you scroll, John, that's the 3.4. Skip that. You'll come in here. You'll select your account executive. You'll just enter your information real quick, and below that, you'll have your uploads. So for a DSCR loan, we're just looking for 10 or 3 in credit. We don't need anything else. There is an option if there was anything else you wanted to provide. Absolutely. If you keep scrolling down, there's another upload bucket down the bottom where, again, if this was a bank statement loan, that there'd be a bucket open to upload your bank statements for calculation. But, anything, any comments, bankruptcies, anything you want us to know in that scenario, you want to go ahead and punch in there, and then you hit submit. And that comes right to your dedicated account executive. So they're going to get it. And as Chris mentioned, he can pre-qual one of these loans in 5 minutes. because we're just looking at that credit, making sure that scenario makes sense. Of course, if there's a question that we need to ask, our scenario desk, our credit team is there inside, what, 6 to 7 hours. I mean, they normally will have an answer on that. So, if there's any questions, we ask for 24 hours up front at our pre-qual. And that, we don't normally need 24. Sometimes bank statement income, depending on time of day when it comes in, we might get it next day. But, our pre-qual process is extremely easy for you guys to use and absolutely imperative for that relationship between you, your realtor partners, your borrowers, because a great AE like Chris here is going to look at your scenario and he's going to put his stamp on it, which is almost as good as gold. Now, of course, there's always something. I mean, there's always the unforeseen that could happen. This is still mortgage lending, right? But a dedicated AE is going to get that. A credit expert is going to review it. They're going to put their stamp on it. And they're going to get you a pre-qual that you can base your pre-approval on inside 24 hours, really at max. And I don't know, Chris, do you have anything to add on that? I'm sorry, but I'm trying to steal the show here.
You're dead on.
Friend in San Antonio, Texas, John, it's a great webinar, so I appreciate that, John. So it's the talent, it's the subject matter experts that I get put with that I'm lucky to be with. So Chris, let's go back to our homepage, right? Let's go, now let's log into the portal where these great marketing materials are.
Speaking of that, if you don't have a user ID, it usually takes like 2 or 3 hours to get one. And your user ID is your email address, and you set up your password. So another thing, if you're worried about it, an AE can walk you through it in 2 hours, 3 hours. You'll be right where John's taking you now. And boom.
Voila.
People ask me, hey, how do I get marketing flyers? And I'm like, I email back, click on or log in, click on marketing, click on flyers, and boom, you're there.
All right, let's go flyers, Chris.
And here we go. Look at this. How many different flyers? I even saw a 2-1. You're doing 2-1 buy downs. You're doing closed in seconds. You guys are doing delayed financing on this. You're doing bank statement HELOCs. It just goes, look at these flyers. Hey, what sales call do you want to make today? You want to go do investors to realtors? Boom, here we go. The really cool thing about this, and John's going to show it to you, is once you input your information in there, company name, NMLS number, logo. Oh, you want to co-brand it with a realtor. You want to put their picture on it, your picture on it. You can do all these things. But once you do, let's say you do the DSCR investor cash flow flyer, it transfers to all of them. So let's say today's Thursday, you want to do DSCR, and tomorrow you want to do asset qualifier and go call them wealth managers. Boom, print that one out and go see every wealth manager within 20 miles. It is this marketing piece. It's literally a marketing plan that you can use for the next 4 weeks to differentiate yourself from every other LO in the community. So let's say, for example, starting next week, you build this marketing flyer. On Tuesday at 10 o'clock, please go out and just push DSCR investor cash flow all day. On Wednesday, and I know this is a different webinar, but go push bank statement loans all day. On Thursday, go push asset qualifier loans all day. And next thing you know, these guys will go, that LO has access to financial funding that no other LOs has. He's got the basic vanilla stuff just like everybody else, but this stuff's great. But I'll try to refocus. I get so excited looking at all this stuff because it's so good.
So Chris, but I think it was Leon on this webinar. Where do we find these borrowers? So let's go to social media, right?
I think social media. I think everyone. If you're not engaging in social media, you're a little bit behind the 8 ball. Nowadays, social media is paramount. So we do have pretty much everything we have in the flyers, we have for LinkedIn, we have for Instagram, we have for Facebook. We have all of these delabeled. So again, we put your information on there. You don't see Angel Oak at all. That's our partnership with you. We want to make sure that you have every tool you have in your arsenal to go out there and educate these borrowers, make you comfortable obviously with programs first, and for you to go out and find these borrowers is huge. There are a lot of loan officers. Again, 67% on this call have not done a DSCR loan. That's a huge opportunity, and making you comfortable, giving you the tools to be successful is a huge part of what your local account executive is going to do with you. We're there with you lockstep every way, any way we really can, because your success is our success. So okay, just sorry.
So Leon asked, where do you find these borrowers? And an example we threw out this morning, and one of the AEs in Dallas did this. He Googled real estate investment groups, right? Stopped counting at 20, and then went with his loan officer and did a presentation in front of a real estate investment group, and no one had heard about a debt service coverage ratio. Chris has got his head down. He's like, "Oh my gosh, that's right."
I call these missionary meetings, and here's why. You have got to go out and spread the good word. I mean, I was at an event last night, and there were it was a realtor event. I was there with some loan originators, and they had never heard of a DSCR loan. And so it's really a challenge to us to do exactly what we're all doing right now, is get out and spread the good word, talk about it, understand it. But as LOs, man, like I said, I would lead with this. And if you don't, your competitors are going to, because I mean, these loans are going on everywhere because it's just a truly a great product. They're easy to close. The rates are great. The realtors love them. You can put interest only on them. There's just a ton of benefits. But it's shocking how many people haven't heard of it. I mean, shame on me for not getting the word out there. Shame on all of us for not getting the word out there harder, because it's awesome.
It's only been 10 years we've been doing it, 12 years. So Chris, talk about, I know this is probably absolutely your favorite, right? Can you see what I have up here?
Realtor presentations.
You got it, my friend.
So your local AE will, or you can do it on Zoom call. I've done them in other states before on a Zoom call. Let me just hit you with this number. For every 10 realtors you bring to a realtor presentation, this is 9 years of experience. For every 10 you bring in, you will get one loan application that day. It happens every time. It is bizarre. If I have 40, that LO will get 4. If I have 20, they'll get 2. If they have 100, they'll get 9 or 10. But here's what we do. We will come in and do a presentation similar to what we're doing right now. And at the end of the day, the realtors are like, holy moly, my DTI is at 60%. I just changed jobs, whatever it is. I could have done this. And all of a sudden, once they understand the product, and again, once that LO becomes confident to do it, they'll be doing it on their own. But we'll do it for you. Like I said, we're your tour guide through non-QM. We'll do these realtor presentations. We can't take loan applications. You don't have to worry about that. I love to go, hey, right there's the guy over there that can take your loan application. We'll have this thing closed on average in 23, 24 days. I mean, their minds are blown. But we will do this realtor presentation for you, or if you feel that you've got enough information to be confident, there it is. You can customize it and use it on your own, which, man, I'd love to see that. I would love to see thousands of loan originators across the country so confident that they just use that realtor presentation right there, insert logo here, and off you go. That means we have been successful at spreading the good word about these awesome products.
Yeah, it's a powerful presentation, and the numbers that Chris threw out are entirely accurate. If you get 20 in a room, you'll get 2. I know we're talking about debt service coverage ratio here, but 9% of the loans we close on our bank statement loans are realtors. So That's where that number comes from. And I bet you it's higher on DSCR, but we don't know because we don't have the job information on the 1003. So,
That's pretty good.
so hey guys, this is where I'll get on my soapbox a little here, maybe sound a little every time we do one of these webinars, it's amazing that people just don't use this. And like Chris was saying, use the social media post on Monday, do a flyer on Tuesday. We have enough content on our website for you to market yourself for probably half the year if you did it every week. I'd say no, probably the whole year if you did it just once a week. So so I would really take advantage of it. Hey Ben, what does it cost to you do these flyers or social media or the realtor presentation?
Big goose egg, guys. That's our partnership with you. We encourage you. I mean, our biggest job is educating loan officers on these programs, getting you guys comfortable with them, and that partnership at a local level is really what sets us apart in the non-QM space. Obviously, that in our experience, and we're the big dog on the street and all of that too. But being there with you and walking you through these processes and making sure that you're comfortable, all your questions are answered, that is really the benefit and the value that we bring. Like I say, Chris and I, we feel like we bring a lot of value to the table just with our knowledge and our experience, and we're going to get these deals done for you. So, getting you that confidence level. But it doesn't cost $1 to do this, guys. We're here to make you money. So, like that's the most important thing is we're here for you. So please use us.
I know we're getting near the top of the hour, so I just want to make sure everyone knows this is recorded. We will get this out to you before end of day. If we didn't answer a lot of your great questions, really appreciate it. We will have your account executive reach out to you and answer your questions. A foreign national person will have your AE reach out and go into a little bit more depth. So anyway, Ben, anything in closing?
Well, I think we've covered a lot. Obviously, Chris, John, we got two of the best right here. But please just get in touch with your local account executive. Again, we're here to do anything we can for you. So, we'll be in touch with you. But, if you ever have any questions, concerns, scenarios, anything like that, just don't hesitate to pick up the phone or choose to text or email, what have you. We're 24/7 kind of people. So, it doesn't matter if it's a weekend. I know Chris has probably dropped 500 calls already in this hour. So, just please, that's the benefit of our experience. So that's about it for me, John.
Chris, great job. Anything else in closing?
Have you guys ever seen Field of Dreams, the movie? If you build it, they will come. If you market this, they will come. So what I'm saying is I'm urging you on your radio show, on your billboard, on your website, put investor expert, investor specialist. If you market this, they will come to you. And you don't have to be an expert or a specialist. Angel Oak will, one phone call away. You can do a 3-way call. We're there for you until you become really an expert specialist after closing about 2 or 3 of these. And you will love your job so much more because you'll just be a leveled up LO, and that's what we're aiming for. But thank you for the time.
Yeah, thank you, Chris, and you're 100% right. So, Ben, thank you very much. Chris, thank you very much. I'd like to thank everyone who was on this webinar, and for those who weren't and registered, it will be sent out also to you tomorrow. On behalf of everyone here at Angel Oak, thank you very much for being here today, and much success the rest of the year. Thank you.
Hey, guys.
Appreciate you guys.